Two guys, same salary, same savings, same starting line. One buys a rental property, the other buys index funds. 20 years later, they both think they won, but one of them wasted years of effort, and the other left hundreds of thousands on the table. And when you actually break down the numbers, the truth is uncomfortable, because neither of them played it perfectly. Let's make this fair. No advantages, no shortcuts. Jake and Marcus are clones. Same age, same city, same $55,000 salary. And most importantly, they both have $50,000 saved. Now here's where everything changes. Jake goes all in on real estate. Marcus goes all in on the stock market. Same money, completely different paths. Jake's move, real estate. Jake uses his $50,000 as a 20% down payment on a $250,000 rental property. Solid neighborhood, 3-bedroom house, nothing fancy, but good enough. He locks in a 30-year mortgage at 7%. Monthly payment? About $1,330. Then he finds a tenant paying $1,800 a month. Do the math. That's $470 profit, right? Jake thinks he cracked the code. Passive income, financial freedom, early retirement. At least that's what it looks like on paper. Marcus's move, stocks. Marcus does something way less exciting. He takes the same $50,000, drops it into a total market index fund, and sets up $300 automatic monthly investments. No leverage, no tenants, no drama, just consistency. And honestly, nobody cares. No one's impressed by index funds. There's no story, no flex, just a boring account slowly growing in the background. Year 1 to 3, the illusion phase. This is where things get interesting. Jake feels like he's winning. Every month, rent hits his account. He drives past the house and thinks, I own that. Tax deductions? Check. Equity building? Check. Property value rising? Check. Everything about it feels powerful. Marcus logs in once every few months, sees numbers go up, then down, then up again. Year 1, approximately $55,000. Year 2, approximately $61,000. Nothing exciting. No one asks him about it. No one cares. If investing had a popularity contest, Marcus is losing badly. Reality check. Year 3, numbers. Now let's stop looking at feelings. Let's look at numbers. Jake collected about $64,800 in rent. Sounds amazing, but here's what nobody tells you. Property tax, approximately $9,000. Insurance, approximately $4,500. Repairs, approximately $4,000 plus. Vacancy, approximately $2,400. Miss-it costs, more than he expected. That $470 per month profit? Yeah, it shrinks fast. After everything, Jake's real profit is closer to $2,000 to $4,000 over 3 years. Not per year, total. And that's without counting his time. Late night calls, weekend showings, stress. Marcus? He invested $50,000 plus $10,800 extra. At approximately 10% returns, he's sitting around $75,000 to $80,000. No effort, no stress, no surprises. But here's where it gets tricky. Jake still has something Marcus doesn't. Leverage. His $250,000 property, now worth approximately $270,000 to $280,000. That's growth on money he didn't fully invest. His equity climbs to approximately $60,000. That's real, that's powerful. And this is exactly why real estate investors love what they do. Here's the part people don't like hearing. Rental income is not clean income. It's messy, unpredictable, and sometimes brutal. Let's break it down. Vacancy. Even one empty month kills your numbers. Maintenance. Rule of thumb, 1 to 2% of property value yearly. That's $2,500 to $5,000 every year. Big repairs. Roof, $8,000 to $15,000. HVAC, $5,000 to $10,000. These are not if, they're when. Bad tenants. This is where things go sideways. 3 to 6 months of unpaid rent plus legal headaches. One bad tenant can erase an entire year. Year 5 to 7, the turning point. By now, Jake isn't dreaming anymore. He's managing. He's had multiple tenants, replaced a roof, handled emergencies, raised rent, but expenses rose too. His real return? Around 3 to 5%. Not bad, but not amazing either. Marcus? Still doing nothing. And this is where compounding kicks in. His portfolio jumps to $135,000 to $150,000. And here's the key. His money is now making more money than he is contributing. That's when things get dangerous, in a good way. Year 10, neck and neck. Jake's property value, approximately $335,000 to $350,000. Mortgage left, approximately $166,000. Equity, approximately $180,000. Marcus's portfolio, approximately $165,000 to $180,000. They're almost tied, but don't ignore this. Jake worked for it. Marcus didn't. Jake took risk, stress, and debt. Marcus took patience. Year 20, the truth comes out. Now we see the full picture. Jake's property, worth approximately $450,000 to $500,000. Mortgage almost gone. Total equity, approximately $400,000 to $500,000. Cash flow profit over 20 years? Maybe $40,000 to $80,000 net. Marcus? His portfolio, approximately $420,000 to $460,000. Total invested, $122,000. The rest? Pure compounding. Same destination, different cost. Both end up in the same range, but the journey? Completely different. Jake traded time, stress, risk, effort. Marcus traded patience, discipline, boredom. The hidden multiplier. Here's the part most people miss. If Marcus increases his contribution by just $200 per month, his portfolio jumps to $550,000 to $600,000. That's the power of compounding. Small inputs lead to massive outputs. Real estate doesn't scale like that. To grow faster, you need another property, another loan, another headache. Let's be honest about stocks too. Stocks aren't perfect. They're brutal in their own way. Market crashes? 2008, down 37%. 2020, down 34% in weeks. Most people panic. Sell low, buy high, repeat. No monthly income either. Dividends? Maybe 1.5 to 2%. That's not life-changing. So who actually wins? Here's the truth most people don't want to hear. Neither strategy wins by default. The winner is the person who understands the trade-offs, stays consistent, doesn't quit midway. When real estate wins, strong rent to price ratio. You treat it like a business. You use leverage smartly. You optimize taxes. When stocks win, long time horizon, consistent investing, emotional control, zero interference. The real mistake? Not choosing stocks, not choosing real estate. The real mistake is choosing blindly because of hype, because of YouTube, because someone made it sound easy. Next time someone says, real estate always wins, or stocks are the only way, ask them one thing. Did you count everything? Because if you didn't, you're not investing, you're guessing. And if you're thinking, what happens if you combine both? That's where things get really interesting.